Alright guys, welcome back to another video. Let's go through the week ahead, how I'm approaching the market, what sectors I'm staying away from, what sectors I would like to take some trades in, the current trades that I am in for the week, and overall just my overall outlook on the markets, because this is a very important week. We have CPI, we have unemployment data, we just had a massive sell-off last week and we had a good bounce recovery, but right now the market is deciding whether it wants to take a risk or if it wants to take a pullback. So I'm not here trying to predict headlines. I'm just setting myself up so I can make money whether the market moves or not. So make sure you stick around to the end to see how exactly I'm positioned, because I'm showing you guys how I'm making money whether the market is going up, down, or sideways. But what actually matters this week? The first thing is going to be CPI, because this is a report that tells us whether everyday prices are still going up fast or they're starting to calm down. We have this coming in on Friday, February the 13th. If prices are still rising faster than expected, the market is going to be worried that interest rates could stay higher for longer. And if prices are rising more slowly, the market feels more comfortable taking risks. So CPI brings us a lot of volatility, especially in tech and growth stocks. So I know usually people see this as, opportunity to full port their evals, but this is a great piece of information for context. You can actually compare the actual amounts versus the forecast for the last while and the previous, so you can actually see, what that means in terms of how this is going to come back, and how this will affect the market, whichever way that the actual number comes in at. Now, the next big thing for me is unemployment rate. We do have average hourly earnings and non-farm employment change, but unemployment rate is the big one for me. This tells us how easy it is or how hard it is for people to find work, because if jobs are staying strong, it shows that the economy is still running well. But it can also keep pressure on rates. So if jobs start slowing, it helps rates come down, but it also raises the question about growth. So when CPI and jobs data are hitting in the same week, the market can swing around even if nothing is, technically broken. So unemployment rates paired in with CPI are two major things that I'm looking at. We also have core retail sales and retail sales tomorrow. That is still going to be some red folder news to take into account. But personally, I am more focused on unemployment rate and CPI. These are just my two big ones. But overall, we did have a massive slide last week in the markets. Tech felt that the most, and I think my portfolio felt that the most since I'm heavily in tech. But I wanted to make a little bit of a piece on sectors to watch and sectors to be careful with this week. So anyone that's watching that is an avid investor, avid trader, I think that you guys will resonate with this very well, and I want to start doing more of this. But overall this week, sectors that I want to watch are going to be mostly fintech and tech. And in general, I'm still watching tech very selectively. Not everything in tech is acting the same right now. Names that showed strong earnings or, good reactions and real improvement like Hood are interesting because they've already proven buyers are willing to step in. If I hop over to the Hood chart, you can see that we absolutely slid on Hood. My average price is at 108 for 100 shares that I own on Hood. And we slid very heavily. If we actually take a look here, we slid around 54% from where those shares are. So this was a massive L for us almost. Like I said in all my videos, I don't pick stocks where I'm scared if they fall 50%. I pick stocks where I'm happy holding them for 10 years without selling them. So Hood is one of those stocks. We got at a very bad price. We got paid very heavily for the cash geared put that we sold. So essentially the swing trade I was looking to take was catching a support zone down here and then looking to cap that upside around the 122 mark. But since we are trading all the way at these lows, I could have scaled into this trade. But personally, we do have earnings on Tuesday, so I am going to be sitting aside, letting earnings do its thing. We have had mass buying pressure. We're almost up like 20% on Hood, which is amazing. So I'm very happy to see that. I'm looking for a swift recovery and back to the upside. I think this one was kind of drastically oversold. Me personally, that's just my personal opinion. I still think Hood is doing great, and I still think they're going to be doing great things in the long run. So this isn't a bad pick for me. So this is something that I am eyeing in the future. Maybe I want to pick up more shares before earnings, or let's see how earnings performs, and then I can take a look at more fintech companies that were maybe beaten down a little bit too much by last week's sell-off, and then enhance the position that I already have in them. Again, I want to emphasize that this doesn't mean that stocks go straight up, but it does mean that pullbacks can be opportunities instead of panic. If I was grabbing Hood at the $73 mark, I would be laughing all the way to the bank for the next few weeks, next few months. Like, we're up 7% today on Hood already. We had like a 15% day on Friday as well. So we've had an amazing bounce and recovery on Hood, and I hope to see it doing that in the future. So right now, the area I'm most cautious in isn't necessarily specific stocks, but stocks that didn't beat their earnings or gave very weak guidance. Because if the overall market bounces, that's great, but these names often just grind up, afterwards with that recovery. And then once that recovery and the rally is finished, we are looking like we're going to have another bit of a grind down. PayPal would be an example of this because this was like the first time PayPal did not beat their earnings in a while. So personally, seeing this kind of bad reporting, we're all the way down at like IPO lows plus like 10%. It IPO'd around $30 and we're sitting at 40, so you're only up about 10% right now if you were holding this thing from IPO. But personally, I don't think there is much more room to continue downwards. I like the outlook on PayPal, but I think right now, since we're up almost 2% today, I think this is more caused based on everything else bouncing up, and this could have more of a temporary upwards before having just a bigger sell-off, before eventually making a recovery, support zones, and then starting to grind back to the upside. And hopefully we get some better guidance, hopefully we get some better numbers on PayPal, because this is a stock that I do want to see in the long term do very well with everything it's working on. So how am I framing my trades this week? I'm very much not forcing any swing trades right into major data, especially. I'm not chasing stocks that have already ran as well, and I'm definitely not buying names that just missed earnings and hoping to have the market just come and save them. So PayPal would be one of those examples where I'm not looking to catch a falling knife right here. I would let this kind of stable out a little bit, make some more structure, whether that be to the downside, whether that be to the upside, and then you can start framing trades around that. It's one of those things where you kind of have to be very passionate about stocks that you like. I just sold another batch of cash secured puts on IREN because we are trading very, very far off. We just missed my price last week where I would have picked it up at a 30% discount, which is unfortunate because I would have loved that. But with a stock like IREN that I'm very, very passionate about, even after that they did have an earnings miss, I'm looking still for that long-term outlook where I'm able to pick this up at a lower price. So I sold about 300 contracts worth of IREN at this level, meaning I'm willing to buy 300 shares of IREN if it drops to $38. I think this is a great price with a lot of upside. So me personally, this is one thing where I'm very passionate about a stock, I'm very educated on the stock, and I would rather have a much lower entry price, and I'm happy to get that. So nonetheless, I was already paid very heavily for these shares. I think I earned about $120 just for agreeing to buy the shares at this level for the duration of the week, meaning at the end of this week, my positions will expire. And if it doesn't come down to this level, I don't have to buy any shares. I just keep that $120 and walk away. We did just form a great support level around the 41.50 mark. So if we do end up actually coming down, I think it'll just kind of bounce off this area and continue up. No harm, no foul, as I like to say. It's one of those things where I am passionate about it, so I am looking to pick up some names that I like at lower costs. SoFi would be another stock that I'm looking at, in the fintech space. I think this was drastically dropped as well, considering that they had a great earnings beat as well. So understanding, how companies actually beat their earnings. Actually, this cash credit put positions is not supposed to be there. You want to check how companies did with their earnings at a time like this, where did they have unnecessary sell-off, and how is the sector doing overall? I love SoFi as a company. There's obviously rumors of it being put into the S&P 500 eventually, so this is a stock where I'm like, dude, I would love to own it at these levels right now. But yeah, so with a stock like this that's kind of just been beaten down overall, there's nothing fundamentally wrong with it, and that's what you have to remember. So when you have a big open P&L like I did, don't panic. Understand what you can do, how you can sell puts in the background, how you can sell calls in the background, and still generate that income to keep your equity balance going like this, even when your open P&L is doing this. The other position I have right now is Airbnb. They do have, this is more of an earnings play right now. And if I did manage to get it at this level, I would be very, very happy. Again, I still think this was dropped off, fundamentally because of everything else dropping off in the tech space. So I am just looking for that, safe recovery of everything for good companies and companies that I would be happy owning for the long run. On the covered call side, I'm still running calls on Dell, Hood, SoFi, and a couple others. Again, these covered calls are merely just here for, background income, as these stocks are kind of just doing nothing. As you can see, like Dell's just been playing in this zone forever. I'm still making money on covered calls, selling them all the way up here. And then once Dell eventually is in the money from where my shares are right here, that means I can sell a covered call in the money where I will earn a fat premium right here, which will make up for this entire time of me having to hold this stock this entire time, all the way back from like November all the way through now to February. And then I can finally sell it, get rid of it, get paid healthy for my patience, and I'll be very, very happy. I'm not trying to squeeze maximum upside out of this week. I'm more focused on the steady income while the market kind of figures itself out. We do have a lot going on, like I said, so this is one of the times to be patient. Let's really understand understand what the market wants to do, where the risk is going, and stay positioned accordingly. And from a trading perspective, this week is genuinely not a week to be aggressive. I care way more about how price reacts after CPI and jobs data, than actual numbers. Then if structure is improving, I'll take a swing. If not, I'm completely fine letting options positions do the work this week, in terms of like covered calls and cash secured put premiums. But that's about it. This week is going to be about patience. The goal isn't to always catch every single move. The goal is to always protect your capital, grow your equity, and stay flexible, because that is how consistency is built. And with a strategy like this, there is no better way to do it, because with a stock like Dell, where I'm okay owning this forever, like currently when I had the shares assigned here, we dipped all the way down, and the entire way down, I'm still earning money on calls that I'm selling up here. And now that we are looking like we're forming a recovery, I'm still selling those calls at the highs, and I'm still generating income on this capital, even though it is in the negative right now. We are open P&L in the negative, but I'm still generating income on this. And eventually, when the stock inevitably comes back above, I can sell that in the money covered call, take a fat premium, walk away with share gain and that premium gain. And that's it. With a strategy like this, all it is watching your unrealized P&L do this, but your equity in the background is doing this. So then finally, once this one shines up right there, your account balance will look even better. Wrapping this up, CPI and unemployment will move the market, but they don't need to move you. So remember, I'm positioned to get paid if things slow down, and I'm ready for opportunity if things show up. Now, this is the balance I'm aiming for this week. I'll recap everything at the end of this week, but if you guys have any questions, make sure to leave a comment in the comment section below. These videos have been doing a lot better now. We're up in the 13 views, above 10 views, which is awesome. So for those of you guys who are watching, I really appreciate it. And if you found value in this video, make sure to leave a like, subscribe, and we'll see you guys in the next one.